Hello and welcome. Today we're talking about early retirement and how that first $5,000 can set you on the path to financial freedom. It's about taking control of your financial future, one step at a time. Remember to stick around to the end, where I've created a chart to show just how much interest you could make depending on age. Let's take that step together. Before diving into investment strategies, understand the magic of compound interest. Imagine investing $5,000 today with a 7% return annually. Over time, this exponential growth can lead to astonishing returns. The earlier you start, the more powerful the effect becomes. Time is your most valuable asset for early retirement. Starting young allows you to benefit from the miracle of compounding. No matter your age, take action today and start building the future you deserve. Your 20s are a golden opportunity to lay the foundation for a future with more choices and freedom. By putting aside even a small amount each month, you're investing in your future self. The key is to simply begin. For those in their 20s, a growth-focused approach is key. A popular starting point is an 80-20 portfolio allocation, 80% in stocks and 20% in bonds. Do your research, understand the basics, and choose investments that align with your goals. Consistency is king. Automate your savings to ensure consistent investing. Set up a standing order to transfer a fixed amount to your investment account each month. Stay the course and keep educating yourself about personal finance and investing. In your 30s, balance enjoying today with planning for tomorrow. Create a financial plan that balances your current needs with your long-term goals. Start investing early, even with smaller amounts, to benefit from compound interest. Diversification helps manage risk as life gets more unpredictable. Spread your investments across different asset classes like stocks, bonds, and property. Find a balance that allows you to sleep soundly while working towards a comfortable retirement. Make the most of retirement accounts, especially if your employer offers matching contributions. Use IRAs for tax-efficient investments and contribute to workplace pension schemes. Saving for retirement is about securing your future freedom. In your 40s, it's time to get serious about your financial future. Assess your current financial situation and set realistic goals for retirement. It's never too late to take control and work towards the retirement you deserve. Section 2. Adjusting your strategy, shifting from growth to stability. As we enter our 40s, our investment strategy needs a bit of a makeover. While growth is still important, we also need to prioritize stability and capital preservation. Think of it like this. In our 20s and 30s, we were playing a fence, aiming for those high returns. Now we're shifting to a more balanced approach, protecting what we've earned while still allowing for some growth. Remember the 80-20 stock-to-bond ratio we talked about for our younger investors? It's time to adjust that dial a bit. A more conservative approach for this stage might be a 60-40 split, with 60% of your portfolio in stocks and 40% in bonds. Of course, this is just a guideline, and your specific allocation will depend on your risk tolerance and retirement goals. The key here is to find a balance that allows you to sleep soundly at night. Market volatility is a fact of life, and as we get closer to retirement, we want to make sure our investments can weather those storms. Bonds, with their lower risk profile, can provide that much-needed stability. This doesn't mean we're abandoning stocks altogether. We still want our money to grow, just at a more measured pace. Consider shifting some of your stock allocation to more established dividend-paying companies. These companies tend to be less volatile than their high-growth counterparts and can provide a steady stream of income, which can be particularly beneficial in retirement. Section 3, playing catch-up, maximizing contributions and exploring options. Take advantage of catch-up contributions as you get older. In the US, this applies to pensions. Contribute more to your pension each year once you reach a certain age. It's like a financial bonus level unlocked. Maximize your workplace pension contributions, especially with employer matching. It's free money, don't leave it on the table. Self-employed, increase your personal pension contributions. Every bit helps, and catch-up contributions make a big difference. Explore new investment options for diversification and growth. Set yourself up for a comfortable and enjoyable retirement. Section 1, the 50s, retirement is just around the corner. Right, let's talk to those of you in your 50s. Now, retirement isn't some hazy concept in the distant future. It's more like a rapidly approaching train station. You can practically hear the whistle blowing. But don't panic, we've got this. The key now is to make sure we're on the right track and have everything in order for a smooth arrival. At this stage, it's less about aggressive growth and more about fine-tuning your strategy for the home stretch. Your priorities have likely shifted from building wealth to preserving what you've accumulated and ensuring it can support your desired lifestyle throughout retirement. This is also a good time to review your retirement goals. What does your dream retirement look like? Do you plan to travel the world, pursue hobbies, or spend more time with loved ones? Once you have a clear vision, you can adjust your financial plan accordingly and ensure you're saving enough to make those dreams a reality. Remember, retirement isn't about stopping. It's about starting a new chapter. It's about having the time and freedom to do the things you've always wanted to do. And by making smart financial decisions in your 50s, you can ensure you have the resources to make that chapter a happy and fulfilling one. Section 2. Balancing act, protecting your nest egg while growing it. In your 50s, your investment strategy becomes a delicate balancing act. You want to protect the nest egg you've worked hard to build, while also ensuring it continues to grow enough to outpace inflation and support you throughout your retirement years. It's like walking a tightrope, but with the right approach, you can confidently navigate this stage. Remember that 60-40 stock-to-bond ratio we talked about for our 40-somethings? Well, it's time for another slight adjustment. As we get even closer to retirement, we want to dial back the risk a bit further. A common approach for this stage is a 50-50 split, with half of your portfolio in stocks and half in bonds. This balanced approach provides a good mix of growth potential and capital preservation. Stocks, while more volatile, still offer the opportunity for your money to grow faster than inflation. Bonds, on the other hand, act as a stabilizing force, providing a buffer against stock market fluctuations. You might also consider diversifying your portfolio further by adding alternative investments like real estate or commodities. However, it's crucial to remember that these investments come with their own set of risks and rewards. It's always a good idea to speak to a financial advisor before making any significant changes to your investment strategy. Maximizing every penny strategies for a comfortable retirement. Every dollar counts when you're in your 50s and staring down the barrel of retirement. Make sure you're squeezing every last drop of value out of your savings and investments. Maximize your contributions to any retirement accounts you have, including workplace pensions and ISAs. Remember those catch-up contributions, they're even more valuable now. Take full advantage of any opportunity to boost your savings and benefit from tax breaks. Revisit your budget and identify areas to cut back on spending without drastically impacting your lifestyle. Finally, consider delaying your retirement by a few years if possible. It gives your investments more time to grow and could mean a larger monthly payout. By making smart financial decisions in your 50s, you're setting yourself up for a comfortable and fulfilling retirement. Section 1. Embracing a conservative approach. As you enter your 60s, the focus of your investment strategy should shift significantly. The primary goal now is to protect your nest egg while still allowing for some growth. This means adopting a more conservative approach to your investments. Time is no longer on your side, and the capacity for your portfolio to recover from market downturns is limited. Therefore, it's crucial to minimize risk and safeguard your principal. A typical conservative portfolio might consist of 40% stocks and 60% bonds. Stocks still play a role, providing potential for growth and helping to outpace inflation. But the majority of your investments should now be in bonds. Bonds are less volatile and offer a fixed income which can help stabilize your portfolio and provide steady returns. Consider also incorporating Treasury inflation-protected securities or TIPS and high-quality corporate bonds into your portfolio. These investments can offer additional security and income. TIPS, in particular, adjust their value based on inflation, ensuring that your purchasing power is preserved. It's also a good time to reevaluate your asset allocation regularly. As you draw closer to retirement, you may want to gradually increase the bond portion of your portfolio even further. Regular reviews with a financial advisor can help ensure that your investment strategy remains aligned with your retirement goals and risk tolerance. In your 60s, generating a steady income stream from your investments becomes increasingly important. Income-producing investments can provide the financial stability you need while allowing you to maintain your lifestyle without depleting your principal. One of the best ways to achieve this is through dividend-paying stocks and bonds. Dividend-paying stocks offer regular income through dividends, which are typically paid out quarterly. These stocks tend to be less volatile than growth stocks and can provide a reliable source of income. Look for companies with a strong history of paying consistent dividends, often referred to as dividend aristocrats. These companies have a track record of increasing their dividend payouts year after year. Bonds, especially high-quality corporate bonds and government bonds, are another excellent income-producing investment. They pay interest regularly, which can be used to cover living expenses in retirement. Consider laddering your bonds, which involves purchasing bonds with varying maturities. This strategy can provide a steady income stream while reducing interest rate risk. Real estate investment trusts, or REITs, are another option to consider. REITs invest in income-producing real estate and pay out most of their earnings as dividends. They can provide diversification and a higher yield compared to traditional bonds, though they do come with their own risks. Diversifying your income-producing investments can help ensure that you have multiple streams of income, providing greater financial security in retirement. Regularly review and adjust your investments to ensure they continue to meet your income needs. One strategic move in your 60s is to delay Social Security benefits and pension payouts. This can significantly increase your future monthly income. Social Security benefits grow by about 8% each year you delay beyond full retirement age, up to 70. This can make a substantial difference in your monthly income. Consider your health, financial needs, and overall retirement plan. Pensions also offer increased benefits for delaying payouts. Check your pension plan for specific rules and benefits. The increase in monthly benefits can be significant, making it worth the wait. Plan carefully to bridge the gap until you receive higher benefits. Consider part-time work or consulting to boost your income. Strategic decisions about Social Security and pension benefits can maximize your retirement income. Enjoy a more comfortable and financially secure retirement. Let's recap the investment strategies for each age group, emphasizing the importance of starting early and adapting as you age. Investing early benefits from compound interest. In your 20s, focus on growth with an 80-20 portfolio. This maximizes growth potential. In your 30s, balance growth and risk with a 70-30 allocation. In your 40s, stability is key with a 60-40 allocation. In your 50s, a 50-50 split minimizes risk. In your 60s, a conservative 40-60 allocation protects your nest egg. Regardless of your age, the best time to start investing is now. Taking action today can significantly impact your financial future. Every contribution brings you closer to early retirement. Compound interest works best with time, but it's never too late to start. Small, consistent contributions can grow substantially over time. By starting now, you're setting the foundation for a secure retirement. Investing is about timing the market, not timing it. Start now, stay committed, and watch your investments grow. Let's take a look at how $5,000 can grow over time if invested at different ages with an average annual return of 8%. This chart shows the growth of $5,000 invested at ages 20, 30, 40, 50, and 60. As you can see, the earlier you start, the more time your money has to grow. At age 20, your $5,000 could grow to approximately $108,000 by the time you retire. At age 30, it could grow to around $50,000. At age 40, it could grow to about $23,000. At age 50, it could grow to around $10,800. And at age 60, it could grow to about $7,300. This demonstrates the power of compound interest and the importance of starting early. The earlier you start, the more your money can grow, turning small investments into substantial nest eggs over time. Don't wait, start your investment journey today.